My dear students, welcome back to our channel. In this video, I will be explaining the Bcom 5th semester subject Cost Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: define cost accounting. Cost accounting is a branch of accounting that tracks, records, and analyzes all costs involved in producing goods or providing services. Its main goal is to find out the exact cost of a product or service, so businesses can control expenses, set the right price, and increase profits. In simple words, it's like keeping a detailed diary of every rupee spent, from buying raw materials to paying wages and electricity bills, so that the business knows exactly where the money goes. Example: imagine a company making pens. They spend 10 rupees on plastic, 5 rupees on ink, 15 rupees on labor, and 5 rupees on electricity for each pen. Using cost accounting, the total cost per pen is equal to 35 rupees. If they sell each pen for 50 rupees, they can see the profit is 15 rupee per pen. Cost accounting is very useful for planning, budgeting, and making smart business decisions. It helps managers save money and run the business efficiently. Next important short question is: to explain the functions of cost accounting. Functions of cost accounting. Cost accounting performs several important functions to help a business manage its money and increase profits. The main functions are: 1. Recording costs. It keeps track of all expenses like materials, labor, and overheads. 2. Classifying costs. It separates costs into types like direct, materials, labor, and indirect, electricity, rent. 3. Analyzing costs. It studies the costs to find out which areas are spending too much. 4. Controlling costs. Helps managers reduce unnecessary expenses and save money. 5. Determining cost of products. Shows the exact cost of making a product or service. 6. Providing information for decision making. Helps in pricing, budgeting, and planning future production. Example: a company making chocolate spends 50 rupees on cocoa, 30 rupees on sugar, 20 rupees on labor, and 10 rupees on electricity per batch. Cost accounting records and analyzes these costs to know the total cost is equal to 110 rupee per batch, helping the company set the selling price and increase profit. Next important short question is: 3. Limitations of cost accounting. Although cost accounting is very useful, it has some limitations. 1. Does not guarantee profit. Knowing costs alone cannot ensure profits. Sales and market conditions matter too. 2. Expensive to maintain. Maintaining detailed cost records, hiring skilled staff, and using software can be costly. 3. Based on estimates. Some costs, like overhead allocation, are based on assumptions, which may not be 100% accurate. 4. Ignores qualitative factors. Cost accounting focuses on numbers and may ignore quality, customer satisfaction, and employee morale. 5. Complex for small businesses. Small firms may find it difficult to maintain separate cost records. Example: a pen manufacturing company calculates the cost per pen as 35 rupees using cost accounting. But if the pens do not sell due to low demand, the company can still face losses, showing that cost knowledge alone is not enough. So, cost accounting is helpful but not perfect, and managers must also consider other business factors. Next important short question is: 4. Notional cost and opportunity cost. 1. Notional cost. Notional cost is a theoretical or imaginary cost that does not involve any actual cash payment. It is calculated for understanding or decision-making purposes. Example, if the owner of a shop uses his own building for business, there is no rent paid. But the notional cost is the rent he could have earned by renting it to someone else. 2. Opportunity cost. Opportunity cost is the value of the next best alternative foregone when a choice is made. It helps in making smart business decisions. Example, if the same owner invests 1 lakh rupees in a shop instead of a fixed deposit earning 10,000 rupee per year, the opportunity cost is 10,000 rupees, the income lost by not choosing the fixed deposit. In simple words, notional cost shows imaginary costs, while opportunity cost shows what you give up to choose one option over another. Both help in better planning and decision-making. Next important short question is 5. What is prime cost? Explain with the help of an example. Prime cost. Prime cost is the total of all direct costs involved in producing a product. These are the costs that can be directly traced to the product, such as direct materials, direct labor, and direct expenses. Prime cost does not include indirect costs like electricity, rent, or administrative expenses. Formula. Prime cost is equal to direct materials plus direct labor plus direct expenses. Example, a company manufactures pens. The costs for one batch are plastic and ink, direct materials, is equal to 50 rupees. Wages of workers, direct labor, is equal to 20 rupees. Packaging cost, direct expenses, is equal to 10 rupees. Prime cost is equal to 50 rupees plus 20 rupees plus 10 rupees is equal to 80 rupee per batch. In simple words, prime cost tells us the basic cost of making a product, which helps managers control expenses and decide selling prices. It's the starting point for calculating total production cost and profit. Next Unit 1. Long questions. First important long question is: define cost accounting. Explain its objectives and scope. Cost accounting is a branch of accounting that records, classifies, summarizes, and analyzes all costs related to the production of goods or provision of services. Its main aim is to determine the exact cost of a product or service so that a business can control costs, plan for profit, and make informed decisions. Unlike financial accounting, which focuses on overall profit and loss, cost accounting focuses on detailed cost information for internal management use. Objectives of cost accounting. 1. Determine the cost of products or services. It calculates the total cost of production including materials, labor, and overheads, helping the business know how much each product costs. 2. Control costs. By analyzing costs, it identifies areas of wastage or unnecessary expenses, allowing management to take corrective measures. 3. Profit planning. Knowing the cost helps in setting selling prices and planning profits. 4. Decision making. It provides detailed cost data for decisions like whether to produce in-house or buy from outside, introducing new products, or discontinuing loss-making products. 5. Efficiency improvement. Helps in monitoring resource usage, improving productivity, and reducing inefficiencies. Scope of cost accounting. Cost accounting covers all stages of production, including material costs, purchase, storage, and usage of raw materials. Labor costs, wages, overtime, and incentives for workers. Overhead costs, rent, electricity, depreciation, and other indirect expenses. Administration costs, expenses for planning, controlling, and supervising production. It also includes budgeting, cost comparison, inventory valuation, and cost forecasting, which helps management plan for future production and pricing strategies. Example: suppose a company makes pens. The raw material cost, plastic and ink, is 50 rupees, labor cost is 20 rupees, and overheads, electricity and rent, are 10 rupee per pen. Using cost accounting, the total cost per pen is equal to 80 rupees. This helps the company decide the selling price, control expenses, and plan profits effectively. In simple words, cost accounting is like a detailed diary of all expenses, which helps managers know, control, and plan costs to run the business efficiently and profitably. Next important long question is: 2. Define cost accounting and explain its importance. Cost accounting is a branch of accounting that records, classifies, summarizes, and analyzes all costs related to producing goods or providing services. The main purpose of cost accounting is to know the exact cost of a product or service, which helps businesses control expenses, set proper prices, and increase profitability. Unlike financial accounting, which focuses on the overall financial position of a company, cost accounting focuses on detailed cost information for internal decision-making. Importance of cost accounting. 1. Determining product cost. Cost accounting helps businesses calculate the total cost of a product, including direct materials, direct labor, and overheads. Knowing the exact cost is essential for pricing products correctly and avoiding losses. 2. Controlling expenses. By analyzing costs, management can identify areas of wastage or inefficiency and take corrective measures to reduce unnecessary expenses. 3. Profit planning. Cost accounting provides data to plan profits by setting selling prices and budgeting production costs. 4. Decision making. It helps managers make important decisions such as whether to produce in-house or outsource, which product line is profitable, how to reduce production costs. 5. Performance evaluation. Cost accounting allows businesses to compare actual costs with standard or expected costs, helping in evaluating efficiency and productivity. 6. Inventory valuation. It assists in calculating the cost of raw materials, work in progress, and finished goods, which is essential for financial statements. Example: a company produces pens. The costs per batch are: direct materials, plastic and ink, is equal to 50 rupees. Direct labor is equal to 20 rupees. Overheads, electricity, rent is equal to 10 rupees. Total cost per batch is equal to 80 rupees. Using cost accounting, the company knows the exact cost and can set a selling price of 100 rupee per batch, ensuring a profit of 20 rupees. It also identifies that electricity consumption is high, so they can take steps to reduce it and save money. In simple words, cost accounting is like a detailed cost diary, which helps a business know, control, and plan costs, improve efficiency, make smart decisions, and increase profits. Next important long question is: 3. Explain the essentials of a good cost accounting system. Essentials of a good cost accounting system. A good cost accounting system is a system that records, classifies, and analyzes costs accurately so that management can control expenses, make decisions, and plan for profit. For a cost system to be effective, it must have certain essential features. 1. Accuracy of cost records. All costs, including materials, labor, and overheads, should be recorded correctly and completely. Accurate records ensure that product costs are calculated properly. Example: if a pen manufacturer records 50 rupees for plastic but actually spent 60 rupees, the cost per pen will be wrong, affecting pricing decisions. 2. Complete cost classification. Costs must be classified as direct and indirect, fixed and variable, or prime and overheads. Proper classification helps in analyzing and controlling costs effectively. 3. Cost control facilities. A good system should help in monitoring expenses and controlling wastage. It should highlight areas where costs are high and suggest corrective measures. Example, if electricity costs are high in pen production, the system should alert managers to save energy. 4. Flexibility. The system should be adaptable to changes in production methods, product lines, or business scale. A flexible system can easily adjust to new cost structures or methods. 5. Simplicity. The system should be easy to understand and operate, avoiding unnecessary complexity. This ensures smooth functioning without errors. 6. Timely reporting. It should provide regular and timely cost reports, helping managers make quick and informed decisions. 7. Integration with financial accounting. A good cost system should work in harmony with financial accounting, ensuring consistency and reliability of data. Example, a pen company using a good cost accounting system records materials 50 rupees, labor 20 rupees, overheads 10 rupees. The system also tracks energy usage, material wastage, and labor efficiency, helping managers reduce costs, set the selling price, and maximize profit. In simple words, a good cost accounting system is like a well-organized diary for all costs, which is accurate, complete, flexible, simple, and timely, helping the business control costs, plan profits, and make smart decisions. Next important long question is: 4. Discuss the difference between cost accounting and financial accounting. Difference between cost accounting and financial accounting. Cost accounting and financial accounting are two important branches of accounting, but they serve different purposes. 1. Purpose. Cost accounting focuses on determining and controlling costs of products or services. It helps management in decision-making, cost control, and profit planning. Financial accounting focuses on recording financial transactions and preparing financial statements like profit and loss account and balance sheet for external users such as investors, banks, and government. Example, a pen company calculates the cost per pen using cost accounting for pricing and controlling wastage, while financial accounting records total sales, expenses, and profit for the whole company. 2. Users. Cost accounting, mainly used by internal management. Financial accounting, used by external parties such as shareholders, banks, and tax authorities. 3. Scope. Cost accounting includes material, labor, overheads, inventory valuation, and cost control. Financial accounting includes all financial transactions, preparation of accounts, and reporting of overall financial health. 4. Reporting. Cost accounting reports are detailed and frequent, designed for internal use. Financial accounting reports are periodic and summarized, designed for external users. 5. Legal requirement. Cost accounting, not compulsory by law, but useful for management. Financial accounting, compulsory under Companies Act and tax laws. 6. Nature of data. Cost accounting uses both historical and estimated costs for planning and decision-making. Financial accounting primarily uses historical data. Example to remember. Suppose a company manufactures pens. Cost accounting calculates cost per pen is equal to 80 rupees, materials 50 rupees plus labor 20 rupees plus overheads 10 rupees to decide selling price and reduce wastage. Financial accounting records total monthly sales 1 lakh rupees, total expenses 80,000 rupees and net profit 20,000 rupees for shareholders and tax purposes. In simple words, cost accounting is for managing costs and internal decisions, while financial accounting is for showing the company's financial results to outsiders. Both are important but serve different purposes. Next important long question is 5. Discuss the various methods of costing. Discuss the various methods of costing. Costing methods are techniques used to calculate the cost of products or services. Different businesses use different methods depending on their type of production, nature of business, and cost control requirements. 1. Job costing. Used when products are made as per specific orders. Costs are calculated for each job separately. Example, a company manufactures customized pens for a client. Materials, labor, and overheads for this batch are recorded separately to find the cost of that specific order. 2. Process costing. Used for continuous production of similar products. Costs are calculated for each process or department, then total cost per unit is determined. Example, a chocolate factory produces chocolate in large quantities. Material, labor, and overhead costs for each production process are calculated to find cost per chocolate. 3. Batch costing. Used when products are manufactured in batches rather than individually. Each batch's cost is calculated, then divided by the number of units in the batch. Example, a bakery produces 100 cakes in a batch. Total cost of ingredients, labor, and utilities is 5,000 rupees. Cost per cake is equal to 50 rupees. 4. Contract costing. Used for long-term projects or contracts. Costs are recorded for the entire contract and analyzed to track profit and loss. Example, a construction company builds a school building and records all material, labor, and overhead costs to determine total contract cost. 5. Operating costing. Used for services like transport, hotels, or hospitals. Costs are calculated for each operation or service rendered. Example, a bus company calculates fuel, driver wages, and maintenance costs for one trip to find cost per passenger. In simple words, different businesses have different ways to calculate costs. Job costing for custom orders. Process costing for continuous production. Batch costing for grouped production. Contract costing for big projects and operating costing for services. Using the right method of costing helps businesses control expenses, set prices, and make better decisions.